Stock market versus real estate investing. Two completely different investments, but one common goal: to build your wealth. So let me ask you a question. Is a 10% annualized stock market return better than a 6% annualized real estate return? Well, let's take a closer look, and I'll let you be the judge. Let's start with a stock market return of 10%. Let's say you invested $100,000 into a stock or a group of stocks and that you received 10% a year. Now, let's fast forward 30 years. Let's assume that you've reinvested all of your gains. Your stock portfolio would be worth an astounding $1,983,739. Pretty impressive, right? Well, let's take a look at investing in multifamily real estate. Let's say you were to invest in a multifamily apartment building with a current market value of $5 million. Let's say you invest $100,000. The same $100,000 you could have invested in stocks, and you share in the risk with multiple savvy investors, similar to buying a stock. But in real estate, you can use leverage, and the sponsor handles getting the non-recourse debt. So let's say we held this $5 million property for 30 years. After 30 years, the apartment building would now be worth $30,112,876 based on a 6% annualized appreciation. But remember, you'd be investing alongside other investors, so you'd be a percentage owner in these gains. For example, if you were a 10% owner, you would own about $3 million of this $30 million property. And as for the assets themselves, I think we can both agree $30 million is a much different result than $2 million. And this is all made possible because we were able to use leverage. Allow me to explain. When we invested in stocks, there was no leverage. So our $100,000 bought us an asset that was worth $100,000. When we bought real estate, we used 80% of borrowed money from a lender and only 20% of investor capital, so our $100,000 bought an asset that was worth $5 million. And even better, as we discussed, we can take advantage of compound growth on a $5 million asset rather than a $100,000 asset. So let's take a closer look at what your gains would be as a partial owner. If the property was purchased for $5 million and the requirement was 20% for the down payment, that means $1 million is needed to purchase the property. Since you invested $100,000, that makes you a 10% equity owner in the property. The value of the property rose from $5 million to $30,112,876. You own 10% of the asset. Therefore, you converted $100,000 into $3,011,287. So here's a quick recap. If you invested $100,000 into a stock that pays 10% annually for 30 years, you'd have $1,983,739. If you invested that same $100,000 into multifamily real estate for 30 years at only 6% appreciation per year, you'd have $3,011,287, over $1 million difference. But here's where it gets really exciting. This is only one side of the coin. Using a simple buy and hold strategy, we're assuming that we bought real estate or stocks, held them for 30 years, just for the equity gains, which is a great growth model. Now let's take a look at the cash flow and income advantages of stocks and real estate by using my favorite real estate strategy. As I mentioned, investing in multifamily real estate is similar to buying stock in a company, in that there are many equity owners and you represent a percentage of the overall ownership. And while it is good to have others share in the risk, there are such things as too much of a good thing. If you spread the risk too far around, you also diminish the reward. The goal is not to remove risk, but to find the efficient frontier, the balance where you minimize risk while still maximizing the return. We'll discuss this concept in more detail in another video. Alright, now before I show you the true power behind my favorite real estate strategy, let's assume 3 factors. Number 1, you average a 10% return on your money through cash flow on every deal that you take part in. Number 2, there's a refinance of the property you're investing in after 3 years. This is after adding value, increasing the rents and the occupancy. And lastly, number 3, you receive 50% of your original investment back every 3 years due to the refinance, and then you reinvest it in another real estate deal. Now, let's take a look at this strategy over time. Year number 1, we invest $100,000 at 10%, and we then receive $10,000 a year in cash flow. Now let's fast forward 3 years to year number 4. We receive 50% of our original investment back by refinancing the property, which means we get $50,000 back in our pocket. We take the $50,000 and then we add the $10,000 a year in cash flow from the past 3 years, which was $30,000 in cash flow plus $50,000 back from the refinance. So now we have a total of $80,000 to invest in the next real estate deal. By year number 7, we are continuing the same process and we're starting to gradually accumulate cash flow. Let's take a look. $10,000 a year is coming from our first deal that we did in year number 1. $8,000 a year is coming from the second deal that we did in year number 4. $6,400 in cash flow is coming from the third deal that we did in year number 7. By year number 10, we add another $10,520 to the annual cash flow. We've now converted $100,000 into $34,920 a year passive income. But this is only year number 10. Let's fast forward and see what happens after 30 years of continuing this strategy. By year number 31, not only would you have converted $100,000 into $1,516,080, which is liquid cash and withdrawable, your real estate holdings portfolio would be worth more than $15 million because you'd be a partial owner on 11 multifamily real estate deals, which have all appreciated over time, like we saw in the buy and hold example earlier in this video. And if that's not enough, you would also have an annual passive income stream of $483,517 from tenant rents. Let's recap. The stock portfolio, after 30 years of compounding, was valued at $1,983,739. That means the stock would have to pay more than a 24% annual dividend just to match the real estate cash flow amount. And if you sold any of the stock, your portfolio and cash flow would then decrease. So here's my question for you. Is a 10% stock market return better than a 6% real estate return? Let me ask you another way. Would you rather have $2 million of stock or a $15 million portfolio of real estate plus $1.5 million cash plus $500,000 in annual income for the rest of your life? To learn more or find out how you can implement this strategy to help achieve your financial goals, click the link below or visit www.directsourcewealth.com.